Good morning, students. We will be discussing today on equity finance. I think in the study pack it's chapter 12. You may refer the study pack chapter 12, which basically talks about the equity financing. As you know that in terms of raising finance, there are two main sources. One is equity, other one is debt. So these are two main sources of funding the organization can have. In fulfilling their requirements of funding. So the equity and debt. So you might see that in your financial statements we have equity capital, which is mainly share capital, but actually when you say the equity word, the share capital and all the reserves together only forms shareholder funds. Debt capital, if you take, it can be your long-term debt instruments and other ways of funding in a debt nature. So it could be a bank loan, short-term loan, long-term loan, all that fall into the debt capital. So we will today we will discuss the equity finance mainly. Those are actually the shareholder funds in the organization. The shareholders funds are the key because those are the people who take risk and invest in the organization. Because debt capital, when you compare, you know that debt capital mostly will have a kind of a security. So if the bank is giving a loan to the company, bank will definitely ask for a security. It can be a mortgage of the property, or it can be any guarantee kind of thing, or it can be linked to some form of asset which could be used also as a security for the bank to finance. But there may be some unsecured lending also you would see, but to great extent they are safeguarded by some sort of a security, or at least a guarantee by some people. You will get a security for a debt capital. But if you take the share capital, mostly the share capital funding is a risk taking, the entrepreneurial side of it, or maybe you take risk in the investment. So if you say one person who starts a company putting own money as shareholder funds and start, or share capital, he is taking the risk of the business. He takes the risk of the business, because if the company fails or the business fails, he is ready to take the risk. And there is no security for him, because the business itself is a security. If the business doesn't do well, he is going to lose the money. But that's called entrepreneurship. But after he start the business as a private individual or private company, he will start the business and grow the business. After a point, he will see that maybe not only him, maybe he could get few people, maybe his friends, family members, or very close contacts. He could get those people also and invest in the company and develop the company. So generally what happens, a smaller organization or smaller company, if you take the actual history of those companies, there would have been one person or two people who would have started a small business, very small business, and they go on the track of developing the business. After a point of time, they will convert that into a kind of a private limited company and get few shareholders who could be your contacts and friends. After that, now these I am talking about the very initial stage of most of the small businesses. After a point, the small business or family-owned businesses will realize that the company is doing really good. Company is really doing business well. So they realize, okay, there is a need to expand the business. So how do we do the expansion? You need to find money. The money. So the finding money, maybe you can borrow money and put it into a business, or maybe your existing shareholder who are 10 people or 5 people also would put the money into company. That is again shareholder funds. So those funding will help the organization grow. But after a reasonable point in time where your company is expanding or developing faster, then there is a need for the organization to find a large amount of money, significant amount of money. So you are not going to be comforted with small amount. You need, say, the amount can vary, but then it's a large amount, which may not be funded by, or may not be in the sense like shareholders, your existing shareholders may not have that funding capacity to support the company. Not that they don't want to, they don't have the capacity to fund it. And even the bank loans, if you take that for the matter, banks are also not going to fund to that extent because it may be a smaller organization. But you realize you have a dream or you have a vision of developing your organization to a significant level or larger company, then you want to fund the company. In that case only you will see, okay, now it's time for you to get into a share market. So the equity finance, actually initially when you start with just shareholders money, somebody invest and start the business and go on the road, and then you get more and more shareholders. It can be your contacts or friends, your relatives, families, they will be investing, and then you develop that company. But there is a point at which you will realize, I need to get more funding because I want to expand my company in a big way. So better way I would say is going to share market. So what I would like to tell you, the equity financing, if you are going to talk about financing from the public or you are raising money from the public, that is share market, then it's going to be a large amount of funding, which is going to be the capital market activity. So in Sri Lanka, if you take capital market, I will say like, okay, you see the private and the government, if you can say, look at it. The capital markets are the markets where you deal with the long-term financial instruments. So when you say long-term financial instrument, shares, debentures are long-term financial instruments. Shares and debentures are generally, in Sri Lankan context, shares and debentures are the commonly used long-term financial instruments. But there can be various other instruments, but which not very much what you call actively trading instruments. So shares and debentures. In terms of private or government sector, it's your treasury bonds, government bonds. So government bonds are the ones which are traded or which are issued by the government to raise funding for a long-term funding. So that's the capital market activity. So when you say the capital market activity, you could put into the two types, private side and government side. Government side, it's mainly the treasury bonds. You are getting funding. And private sector, it's mainly onto the share market and the debenture market. In Sri Lanka, share market and debenture market. So just to get an idea about the overall capital market, how it works, basically you have in Sri Lanka, it's government bond markets, and the private sector you have a share market and the debentures market. And the capital market is compared with the money markets, right? So money markets. So what is money markets? Again, these are markets where you will see that short-term financial instruments are traded, or you do deal with the transactions in the short-term instruments. So it can be your even a big deposit, bank deposit, even your short-term borrowings and a repo, reverse repos, commercial papers, unit trust or money market, other instruments, all that fall into this activities of money market. So these are short-term financial instruments where you can do transactions to find your money. You find your money, or maybe you are investing your excess money. So that's basically the money market activities. So you have two things. One is called money market activity, other one is capital market activity. I am just touching upon different area while we are doing the main topic. So money market activities are short-term instruments, your transaction happening. Capital market is about long-term instruments. Under long-term instrument, if you look at private sector and government sector it's the treasury bonds transactions. Private sector it's a share market or debentures market. So if you take page number 320, the study pack, actually now we are going to talk about capital market, under which the share market, stock market. So stock market is the market in Sri Lanka where you basically transact in shares, mainly shares, to buy and sell shares by the investors in the market. So in Sri Lanka, the shareholders or the investors who want to get into the capital market activity can buy and sell shares. But when you take the market, there are again you can divide into two types, primary market and secondary markets. Primary market is where you straight away deal with the person who is investing. You are straight away dealing with the investor. So if I am, say for example, I am an X company, I am raising money, right? I am raising money, So I am raising money from the public at large. So if I am issuing shares and getting the money from public, so that's the capital, or what you call the primary market. That's my transaction is I issue to the investor and get the money. That's the primary market, the type of transaction. Secondary market is where after the shares are issued, at the beginning the IPOs shares are issued to public. After the shareholder or the investor who gets the shares, he is now the shareholder of the company. He can sell the shares or he can buy the shares in the stock market. Those are secondary market transactions. That is secondary market transaction. So if you say the transaction happening between the issuer and the investor, it's a primary market transaction. If you talk about somebody who has already got the investment, if he buys and sells the investment or the shares, it's a secondary market transaction. So basically you can look at page number 320, which basically talks about under stock market, right, primary markets and secondary markets. So generally the secondary markets is key for any kind of capital market transaction, simply because you say you have bought the shares in the IPO, initial public offering. We will discuss the IPO also. Initial public offering means where the company is issuing shares to public at large through the stock exchange. So when the investors have bought the shares, after he buys the shares, he is a shareholder of that company and he can sell the shares at any time. He can sell the shares at any time in the market. So he can call the broker and say that I want to sell my shares. Broker will facilitate the transaction. But there may be situations where some company shares are not traded actively in the stock market. Right? After you buy the shares couple of years later or maybe months later, if you realize that there are no much people or there are no many people in the market who is interested in buying the shares. So that means there is no liquidity of the shares, So there is no demand, neither supply. So sometimes you will have supply, no demand, sometimes you have demand, no supply. So you will realize that there are situations for some company shares, there is no much of a liquidity in the market. So that is what important, the secondary market is that, where if you can't sell your shares in the stock market when you wanted to, then you have a problem. That means there is no liquidity of the shares. That means secondary market is not active. I think good example is the debentures market in Sri Lanka. So I said private sector transaction, you can be having the stock market or the debentures market or the share market or debenture market. So debentures, as you may be knowing, there are successful banks and the finance companies or maybe some corporates have issued debentures in the past for a long period. They issue the debentures to public and raise money. So after raising money, the debentures could be listed. They will list the debenture so that anybody can buy and sell debentures in the market, like share market. But to be honest, the debenture market is not that active compared to share market in Sri Lanka. So even though the companies or corporate issued the debenture and got the money, their purpose is achieved. Why they got the money? Then they have to redeem, or at the time of maturity they have to pay the debenture money. So that is from their point of view, they have got the money, they will pay only at the maturity, which can be 5 years or whatever period. But the investor point of view, he bought the debenture or invested in the debenture and he has in his mind, in case of a requirement of liquidating, in case I want to encash my debenture, I should be able to trade in the market. So some of the finance company, banks or corporates should have told these debentures are going to be listed. So if it is going to be listed in the debentures market, then as an investor you can sell the debenture at any time. That's the basic idea you are trying to get. But reality is there could be sometimes some debentures people don't trade. There is no buyer, there is no seller. Even if you want to sell it, there is no buyer to make the investment. So if that is the case, there is no secondary market. So what I would like to say is the liquidity of your shares or debentures is important for transaction to take place in these kind of markets. Otherwise this market doesn't get developed also. If there is no liquidity in the market, people don't have confidence about listing. But to be honest, share market, no problem. We have to great extent most of the company shares are liquid. But there are very few company shares are not liquid. That is where the shareholder, if he has bought it and he wants to sell it, he will have a problem in selling it. because there won't be maybe buyers in the market. So that is something a concern for the illiquid stock. That is why we have the regulatory point of view. Stock Securities Exchange Commission generally brings up rules to make sure that you have a minimum float or public float of the shares, So that is basically requirements. Stock market activities are controlled or regulated by the regulator in order to make the shares liquid in the market. So please understand, this is called capital market, where you have the raising of capital through the shares. So we talked about shares or long-term instrument. We are now concentrating on the stock market, where the shares are issued to public to raise the money. Under that you have a primary market and secondary markets. Then going to this terminology, some of the terminology, institutional investors. If you take the study pack, I am just browsing the study pack while I am discussing. Institutional investors are whom? The investors who have large amount of funds, who would like to invest. It can be, the investment can be what you call shares, it can be bonds, long-term bonds, or any type of assets which gives you satisfactory return and the risk. So this is basically the institutional investors' point of view, who would like to invest in those kind of instruments. In Sri Lanka, your institutional investment, if you take example, provident funds, EPF, ETF, that is employee provident fund, employee trust fund, and pension funds, and the insurance companies, especially the long-term insurance companies, long-term in life insurance companies, who have excess in the sense, like they have their customers' money, but then you don't need to pay them tomorrow morning, you have to wait for their maturity or the death of the customer. So therefore you have the money with the company for a long term. It's not a short term, long term. General insurance company get the money, but it's for generally short term, 1 year period of the policy. But long term policies are long term, so you get more money and keep it for the claims and maturity at the later period. So very long period, so 15 to 20 years period. So therefore you have the monies with you. So the insurance company, EPF, ETF funds, even certain corporates who have large excess funds, those people are called institutional investors. Why I am trying to explaining this terminology, because sometimes the examiner has given this word institutional investor somewhere, and then your question can be referred to that. So you should know who are these people. They are generally the people who have, not the person, individual. Institutional investors are companies, corporates. Only thing, they have excess funds. Generally the excess funds people are the provident funds, pension funds, and the insurance companies, and large corporates who have excess funds to invest. I think here they have given you the unit trust companies and the venture capital company. Those are the people also will have money to invest. Then there is a graph or a table you can see, 11.1 figure, where it basically shows this how the capital market activity is taking place. So you can see in the graph or the table, you can see that there are demand for money. People need money. So capital market activity to take place, there should be need always there. So need is the individual's point of view. You and me might want the money for, say, housing or consumer goods financing. Some reason I want money, either to invest in capital expenditure or revenue expenditure. So I would need money. Companies, when you take corporates, companies, it can be small business, large businesses, they want money. They also want money to run their organization, to develop their businesses. So it can be a share capital form of money or loan type of money they want. Somehow they want money from somebody. Government wants to raise money to fund their budget deficit. That is basically your expenditure, revenue capital expenditure reasons, government wants money. So there are three people in this whole thing we are talking, individuals, companies, and the government. All three people wants money. So they are the one who really create the need for money. If there is no need for money, there is no supply also. Right? There is no demand. So demand is created by these people. Then you see the supplier, who are going to give this money. There are again individuals. There are people, individuals, who have excess money. There is one segment of people, again individuals, they want money. on one segment of people who has excess money. Maybe that people who have earned, even they could earn more money than other people, then they have more savings, or maybe they have inherited most of the deposits and their finances, so they are able to fund or invest somewhere. And maybe there are people who are pensioners who have got enough money at the retirement, gratuity and pension, EPF, so they get excess money, so they want to invest somewhere. So there are people, that is individual who wants to invest, and there are maybe individual who want to save money on a regular basis, small amount even, but they want to save money. Then the companies wants to invest long term, because like I mentioned you, these institutional investors, who are the people who say I have money, I want to invest. So I don't want to keep my money at just in non-interest bearing instrument. I want to invest somewhere to earn money. So they are willing to invest in a long term nature in instruments. So they are waiting to find products so that they can invest in the products. Then the government also would have sometimes have budget surplus, where the government has excess money. So you see there is a demand for money created by three identified people, and the supply side also we have three identified people. So these people don't meet each other. They are not directly meeting. Like for example, I may have excess funds, my neighbor must be wanting money, or maybe the other way also. My neighbor would have excess funds, I want money for building my house. So what do? I don't go to my neighbor and say, can you give me money? Then he also will not give the money. So because I am not so sure whether you will be able to repay the whole money. So there may be doubts. So this is where the intermediary comes in. So who are these intermediaries? So you can see there are a list of intermediaries: banks, building society, insurance companies, pension, unit trust, investment company, stock exchanges, venture capital. So these are the intermediaries. Actually what's happening, my neighbor, he has excess money, he goes to the bank and deposit the money. Next day morning I go to the bank and say, can you please give me a housing loan? So bank gives me a housing loan. So what had happened, my request for money is supplied by my neighbor, but not directly, through an intermediary. So therefore you need to understand, this is how the capital market takes place, capital market activity takes place. This table is a very meaningful table, right? So please understand. Then advantages of stock market listing. Now why the companies have to go for stock market listing, right? So you may be knowing this in detail. There are various reasons, advantages. So if you see there is in the study pack there is a kind of a relationship shown why you need a market listing. Okay, so after that I will add on certain points, other points. One, they say access to a wider pool of finance. So you are able to get more finance, right? You get more money or more finance. If you want to raise more finance, you can go for listing. Then they are talking about marketability. If you are an unlisted company, you all know that you are not able to sell your shares. In the sense like you can't go to market and sell if it is an unlisted company. You need to speak to your other shareholders and say that, okay, I am interested in selling my shares, can you please buy? And if the other shareholders say, sorry, we don't have money to buy at this point in time, so we can't help you. So that is a problem at that time. So that is where the unlisted company shareholders feel the difference between the listed company and unlisted company. Listed company, the advantage is if you are a shareholder, as I mentioned, the secondary share, primary market you bought the shares, or in the secondary market you bought the shares, you want to now sell it. So you can go to the stock market through broker and say that I want to sell my shares, and there may be some buyers to buy the shares. So marketability is very high in the listed company, unless there are specific situation where you have very less liquidity of your shares, then your problem is selling. Otherwise, generally, don't worry, you are able to sell the shares. That is why it's called marketability. So listing advantage is marketability of shares. Then image, generally the public image. Generally, everybody knows that if you are listed, there is an image created. That image creation comes with the many things. One, it's you are a listed company, means there are a lot of regulatory requirements you have to fulfill when you are going for listing. So that means you need to be reasonably a good company. Good mean what I mean? In terms of profitability, in terms of your activity, in terms of your corporate governance, in terms of risk management, there are various aspects. and disciplines, compliances. So you are getting a little bit of a very good image in the marketplace. Because of the regulatory point of view, you have been managed. So since regulations are taking place in this organization, anybody knows, okay, this is comfortable, I know that this company is listed, and there is a image you create. In addition, you are a larger company. Not a very small company is listed, but there are different boards nowadays, right? So you have main board, second board, and then this is a board. So you see that there are different board, you can look at it, but end of the day, you are getting an image in a public point of view because you are a listed company. And generally you are, if you are a loss making and kind of a very unethical business or defaulting company kind of thing, then will not be in the listed market. Stock exchange will somehow make sure that you will be transferred from your listed market. So you see that there is an image of listing. Then original owners realizing, when you go for listing, as I mentioned at the beginning in the morning, when you say you have developed your business, you have 10 or 15 shareholders, your family members and friends, and at a point then you say, okay, I want to go for listing. When you go for listing, there is a possibility that your existing shareholder, maybe one or two, would like to get out of your ownership, because they would have said, okay, I have waited in the company for 10 years and I have waited, now I am able to realize my investment. So one of the way that you will realize your investment is company going for listing. So there are reasons why the company go for listing is to realize their existing shareholder investment. So that is a realizing reason. Then easier to seek growth by acquisition. To acquire companies, right? So you need to understand that if you want to grow your company, there are two ways you can grow. One is organic growth, other one is by acquisition. Organic growth is where you develop what are the businesses under your company. Develop your company or businesses within yourself. Maybe, for example, you want to get into pharmaceutical business. Not that you go and buy pharmaceutical business. You will try to develop from your resources, develop that pharmaceutical business, so that it is yours. It's organic growth. But on the other hand, if you realize, okay, I want to grow and getting into pharmaceutical industry, what I do, I look for a pharmaceutical company in the market and go and buy the pharmaceutical company. So when I do that, I am growing, and again I want to grow in terms of pharmaceutical industry. I am growing, but not my own, that is not my organic growth, acquisition. So the listing will help you to buy companies, the acquiring the company, because listed company, if you want to sell your shares or sell your organization, you can get listed so they get a good value and sell it. Then you see there is a market value. One of the other advantage of listing is market value, because if you are an unlisted company, even though you can value your shares using valuation methods, whatever we have learned, you would realize the market value is always available when you are a listed company. Unlisted company you can value and say my share is worth 100 rupees. But there is no one in the market or public or investors point of view who comes and say it is 100 rupees worth. But in a listing, the advantage, tomorrow morning you call the broker and find out how much my share is trading at. He will say today 120 rupees. So that is your price. So market value is available, readily available. So this is one of the good thing about listing. You don't have to sit and talk to many people and find out whether it's right price, wrong price, calculation right. There is an established market in Sri Lanka or even other countries, developed market. So that market transaction take place. So there is a buyer, there is a seller. Somebody is willing to buy your shares at a price. So there is a market value available. So listing, there is an advantage of getting a market value. Then one of the other advantage which is in Sri Lanka at the moment I would say is a tax concession. By listing, I think this year the government allowed or government is encouraging the companies to get listed, because only 290 companies in Sri Lanka's stock market, very, very small in terms of the number of companies in Sri Lanka stock market. So 290 companies is not very large, right? So looking at the total companies in Sri Lanka, number of companies listed is 290 only. So the government is pushing the most of the good successful companies to come into market, so that you get a larger stock market capitalization, as well as the other organizations also will develop themselves with terms of expansion of capital. So tax concession is given. So there is a 50% tax concession for the people who are getting listed. There are a couple of companies already listed. You would have seen that Windforce listed, Primelands listed, and I think there are Chris World company, and there is Jet Holding is coming into the listing. So there are organizations coming for listing. So why there are many reasons like what we talked about. One of the benefit they get will be tax concession. So these are the advantage of tax listing, or the listing the company, advantage of listing the company. Similarly, you have disadvantage of listing, disadvantages of listing. So you could see in the study pack, disadvantage of stock market listing. I am not taking one by one points, so you can read out, right? Just to understand, few issues with the stock market listing is, you have compliance costs. Once you get listed, not only at the time of listing you have to pay some fees, after that you will see that continuous listing rules are there. So you have to comply a lot of requirements of the stock exchange or SEC, Securities Exchange Commission. You will have a lot of things to be complied with. So when you go to comply with all these requirements, there is a compliance cost. So that is something the organization will decide whether I am willing to do that, because that cost could be, when you say a larger amount of money you have raised in the stock market, this cost may be very negligible. But some company, small amount if you have raised, you have a problem, compliance cost. Then the compliance cost is one, otherwise compliance requirements. When I say requirements, where you need to disclose things. Now for example, if you are going and starting a business in say another country, your board have decided to go and invest in Bangladesh. Your board has decided with Bangladesh development you have seen over the COVID period and previously, you realize that is a very good time to get into Bangladesh business, so you are going and investing. This, if you are a private organization, your decision making is in your boardroom. And you basically go and invest in Bangladesh and you make money from the Bangladesh. All that can be done. Public may not know. Nobody will know in the market. Only your company will know, maybe if at all certain regulatory authorities, if you want to get permission, you will inform them and get the permission. But public will not know. But if it is a listed company, when you decide to go into Bangladesh operation, it's a board meeting, decision making you are going through. But if you are a listed company, this kind of investments which are sensitive information for the share price, you are requested or required by the listing rule to communicate to the stock exchange, so that the investors of the stock market will get to know that your company is going for investment in Bangladesh. This is one of the compliance requirements, right? There are so many things like that. You might have related party transaction in your company. If you are a private company, your related party transaction may be, if at all, in your accounts, annual report. But if you are a public listed company, you are informing the public at large. So please be aware that this may be a problem. To some of the organization, because this is confidential, right? When you go to say, you have to disclose confidential information to public at large, so that other person will also get to know that there is a very good lucrative opportunities in Bangladesh. So somebody, your competitor also will get into that business. So that is one of the other issue with the compliance requirements. Okay. So one is the cost related aspects, other one is the requirement itself. Per se, the requirement itself will push you to do that, but it may or may not be beneficial for you in the marketplace when it's competition concerned. Then the disadvantage, when you look at it, your reputation, when we said the image you get created, similarly your reputation also can be affected for slighter thing happening. I am sure like everyone would have looked at this recently, the Portugal football player Cristiano Ronaldo, right? He had kept the Coca-Cola bottles away from his conference, what had happened? Share market value dropped by $4 billion. $4 billion. Share value of Coca-Cola came down by $4 billion. Why? A slight activity, slight action. So this slight action may or may not have affected if you are an unlisted company. You wouldn't have seen it. But when you say if you are a listed company, people see it. Every action in the marketplace affect your share price. So that can affect your price significantly. So your reputation can be affected simply with a small activities. So that is what one of the disadvantage of listing. Then your disclosure requirements in accounts. True that accounting standards will require you to disclose a lot of things, but with this listing, you will be forced to do a lot of things, lot of disclosures. So when you go to do disclosures, sometimes your confidentiality of your business secrets, your strategies also shared with other people. This may or may not be beneficial to you, right? So please understand, these are some of the other issue. And when you say you are listing, you are not talking about 10-15 shareholders. You have many shareholders, so you will have to have separate division to handle the shareholder requirements, and the shareholders will be demanding certain things, even though you may not do that thing, but they will be demanding from shareholders concern. So these are the small issues you will get into listing. If it's an unlisted company, nobody bothers, right? Your own shareholders are your own family members or friends and close contacts. But here we are talking about public at large. So anybody could write to you, they can write to papers, and they can do anything because that's their public. So please understand, those are some of the disadvantages of listing. Even though we have a lot of positives in stock market listing, there are few negatives also. But in terms of growing and from the broader point of view, I would encourage these companies have to get into listing, so that country develop, companies develop, and that businesses develop. Because the reason is, otherwise you are going to be with a limited capital. Actually, listing will help you to develop a lot of capital. Because if you talk about your company wants to raise funding in other countries, you want to go to the other country and raise funding. It can be a debt funding or equity funding. You need to be known first place. in the market. So if you are an unlisted company, maybe little, not very much known in the market. But if you are a listed company, your financials are published, you have more compliances, you have transparency, and most of the committees are in place, audit committee, remuneration committee, related party committee, all that committees are in place, and your risk management is perfect. So you will see that when you go for listing, there are a lot of things evolve in your organization. Those are the benefits. So that gives you a strength when you are going for funding in an international environment. It can be a debenture issue, it can be a share issue, you get the investor to invest in your company. It can be done effectively when you are a listed company. So those are, in the long run, you have definitely benefit. Maybe when you look at it from a narrow mind, saying that okay, your listing requirement, I have to comply with it, I have a cost. Those are things, true, those are there, not that you don't have it. But I would say that when you look at the benefits on a long run, as a company, as a country, it's a very large benefits you will accrue. So better, I would suggest companies look for listing. And I think one of the disadvantages I didn't talk about was the threat of accusation. When you are a listed company, your shares are traded in the market. So if anyone wants to buy your company, he can approach to buy your company through the stock market. But if it is an unlisted company, it's very difficult for somebody to come and just buy. Why? Your existing shareholders could be your very close family members or your friends. So very difficult for the outsider to convince all these people to buy the shares. But if you are a listed company, there are public shareholders. So public shareholders' point of view, they don't have a kind of a very close loyalty or love towards the company. They just look for the investment return and they will sell the shares. So it's for outsider, it's easy to buy a listed company than an unlisted company. So that is one of the disadvantage or risk going for listing. So just keep those in mind. Then moving on, how do we get the listing? How do you get the listing? If you take the study pack, there are various ways you can get listing. One general one is the IPO, right? So we will talk about that more. One way of getting listing is IPO. What is IPO? Initial public offering. It's called offer for sale. Where my morning example, where the company, the owner started a small company, small business, and he develops, and over a period of time then you come to a reasonable size of your company, and then now you realize that I want to raise more money. So at that time what I do, I go to the listing. How do I do it? It's called initial public offering, because first time I'm going to issue shares to public. I go to the stock exchange and tell them, actually Security Exchange Commission, they are the regulator. I go and tell them, look here, I want to get my company listed. So they will give you all the listing requirements. How do you get listing? So you need to study all that and get kind of manager to the issue, and maybe you get a consultant to the issue, and you may get audit services to get your audited accounts finance, and there is a accountant's report, all that you need to look at it. So these people also will contribute to your listing process. Then you will pay your requirements, and then you will comply with all the listing requirement, documentation, all that story. Once you get listed, you are going to issue shares to public. So when you are going to issue shares to public, one of the other important document is called prospectus. So prospectus will have a reasonable amount of aspects of the company. So the prospectus will talk about what your company is all about, what is your financials, who are the owners, present owners, and what are the industry you are working on, all that information. And further they will say, from the money you are going to raise from the IPO, how that money is going to be used. And they say, for example, 1 billion I am raising capital. That 1 billion, why I am raising 1 billion? The shareholder or the investor will ask this question. When somebody comes and tells me that I am issuing shares, I being an investor, I would like to know the 1 billion money, where the company going to invest. So company has to explain that in the prospectus very clearly. The 1 billion will be going to be used to invest in some projects, or to reduce my borrowing. Some of the borrowing I want to reduce, and mostly it will be investment. They will have to tell that it has to be for investment, but sometimes you will see that the portion of the money will be used to settle the present borrowing, debt capital. So this is the IPO. IPO is initial public offering, where the company issues shares to public at large to raise money. So there is a price established. You value the shares by independent chartered accountant. They value the shares and say this is the price. So you use that price, and management decide the price based on that valuation. Management decide the price and tell this is the price, and SEC also approve the price. Then you have offer to public. So the people who are interested in buying the shares, will be buying the shares. So when the company say X is offering 10 million shares, and the public is willing to say invest 15 million shares. So you will see 10 million shares is only offer, 10 million shares is offered, 15 million shares demand is created. So the 5 million shares is excess, 5 million shares is excess. We first call it, this share issue is oversubscribed. This terminology you would have learned, oversubscribed. That means you are 10 million only company offering to raise money, but the demand is 15 million. So oversubscription. Similarly, if the 10 million is issued and only public is willing to invest only 5 million, so they are not interested in buying the entire 10 million, 5 million only they are interested. That is called undersubscription, right? Oversubscription, undersubscription. So this is the normal trend. In order to make sure that your shares are subscribed properly or oversubscribed, you need to you need to do promotion, that generally the people do, and then they have to basically kind of induce the market to buy the shares. So you can have your articles in the paper, maybe some press conferences in the media. So these kind of thing you do, so that people will be aware about this company, what this company is all about, whether it's a lucrative investment for you to invest. All that will be done in the IPO process. So oversubscription, undersubscription. The other thing, when you realize the shares what you are going to issue may or may not be subscribed fully. If you find out that it's not going to be fully subscribed, if it is not going to fully subscribe, what you are going to do is, you will have a process called underwriting. Underwriting. You get intermediary who is called underwriter. You will tell him that I am interested issuing shares to public at large, but I have a doubt whether that all shares that I am going to issue will be subscribed by the investors in the public. In that case, the underwriter will come and say, okay, fine, any amount of shares which is not going to be subscribed, you say 10 million shares I am going to issue, only 8 million going to be subscribed, 2 million short. Which means the company point of view, company not getting 2 million worth of shares value. I am not going to get money. So I have a problem. So the underwriter will take that responsibility and say that if nobody buys your shares in the market, or maybe the shortfall, I will buy the shares. I will buy the shares. So that is called underwriting process. Underwriting process. So generally the company which have doubt in raising capital from the market properly will go for underwriting process. Underwriting process. So please be aware that there is an underwriting process also in the IPO. Only thing, the amount of money you have to pay in underwriting also, there is a cost involved. Then you may look at that example where they have given you about the share issue, the pricing. Generally the pricing is worked out by the independent valuation, and then the company will decide what the right price to offer in the market. So there are various things, you look at it, please be aware. When you go to price, when you are going for IPO, you generally try to keep your price lower to attract the investors to buy the shares. For example, if the share is valued, if your share is valued on various valuation method, and say you find there is a fair value of share, fair value, say it is 18 rupees. Fair value 18 rupees per share. When you do the valuation, you realize your share is reasonably fair value is 18 rupees. So when you are going to IPO, to issue to shares to public to raise money, your offer price, what you do, don't put it 18, don't put 18, you put 16, you put 16. Why you do that? So that even the investors, when they work out through their brokers or other investor advisor, they realize that share is worth 18, but it's coming to the public offer at 16. So if I buy the shares at 16, I know that I have upward potential for my share value to 18 rupees. So I will get a good return immediately after listing. Immediately after listing the shares, I am able to get a good return for my investment. So this is the kind of a perception you have to create when you are offering shares to public. If you say your fair value is 18 and you say that your offer price is 18, this is something investors are not very much induced. Why? Even though the share is worth 18 and you are paying 18, still people don't see that much of a benefit, because once the shares are listed for trading, your share is trading at 18, which is the price you paid also. So there is nothing that you gain out of you getting into offer, IPO you buying. So therefore please understand your share price needs to be reasonably priced, so that there will be an inducement to the investors to buy the shares. The other important thing is, when you are pricing, you need to look at what is the market condition. Whether market is market environment is good for anybody to invest. Market environment is good for anybody to invest. So if the environment is good, then you can easily promote your shares. One good thing at present context, I would say, is the interest rate environment. All of us know that interest rate in Sri Lanka is very low, right? Interest rates are very low rates, very low. Since the interest rates are very low rates, you have advantage of promoting shares. Why? If you are a good company investors will say, okay, better I invest my money in share market, good companies, so that I get a better return. Why? Interest rates, if you say you are going to put it in the bank deposit and you get 4%, 4% interest per annum. 4% nothing, 4% nothing. In the return point of view, it's very small return. And Sri Lankan point of view, where the inflation is more than 5-6%, so you are talking about interest rate 4%, that means your real interest rate is actually negative. Real interest rate is negative. So please be aware that when you say interest rate is 4% and your inflation is 6%, that means your value of money goes down. Value of money goes down. So therefore, if you realize the investment opportunity where it can be property, it can be stock market or various other alternatives, where you realize that you are going to get more than say 10% whatever you are expecting, then you will definitely move your money from the other markets to the share market, or fixed income security market to the share market or property market. So there is a huge demand for the stock market transaction, provided you are a good company. You are a good company. So IPO is a good option for some of the companies at this moment, because there are enough people who are waiting to invest in various alternatives, because they understand that market interest rates are very low. No point in putting the money in banks or government security or debentures. Better to put the money into some businesses. You can't be starting businesses already or immediately. So it's better that you invest in a company which are doing good. So you put your money there, so you are able to get better returns. So this is something you need to be keeping in mind when you are talking about investment. Then they are talking about prospectus issue. Prospectus issue, you can read it out. Right, where prospectus issue is where you are talking about issuing your shares to selected, not selected actually, you directly issue the shares to public, right, where you issuing through a prospectus, So that is very, if you are listed company, very rare. In Sri Lanka, I think it's very rare where you are basically issuing shares to public, general public to be straight away, right? Very circumstances are very rare. So in Sri Lanka, we have this what you call IPO, where you issue shares to public through a stock market, stock exchange. But directly, if you are issuing shares through a prospectus, that is called the share issue by prospectus, where you directly issue to public without getting into stock market. Third one, the placing, right? Second one is the prospectus issue. Third one is placing. Placement is actually where you will identify selected investors. It can be institutional investors. You will identify selected investors and you basically go and issue shares to them and they become the shareholder of your company. So it's not a public at large. You very selected investors, you go and raise your money from them. You don't go to everybody, you have a very selected people. That's called placing. Right, third one. Fourth is by introduction. Actually here, the by introduction is where you are not raising money. Here there are no new shares issued. Please understand this introduction story. There are no share issued to public. Only thing what you are doing, you being an unlisted company, you are converting your status from unlisting to a listed company. So please be aware, this is called introduction. This is also you are listing your company, which means your shareholders will not change, right? Your value of your company actually you will change because you are unlisted company, it's no market value, but here there is a market value coming. So there is a thing. So anybody of your shareholder can be able to sell your shares in the market after listing. But you are not raising money. You are not raising money like IPO, and there is nobody investing in your company, and there is no new shares issued. This is called by introduction. I think in Sri Lanka, a good example was the few years back, Central Bank said you can get the finance company listed. Central Bank wanted finance company to be listed. So at that time, some of the finance company didn't want to raise capital, but they just want to be in listing because the central bank required. They went for introduction. So basically, they are a company, they run their business as it is. Only thing they say tomorrow onwards we are listed. So anybody who would like to sell the shares in the market could be able to sell the shares. Similarly, anybody who wants to buy the shares in the market of that company can buy the shares, provided somebody is selling. So that is called introduction. So please understand, IPO is where you are raising money from public at large. Prospectus issue is not through stock exchange. You issue shares to public and raise money. This is very rarely happening. Placing is where you identify a group of people and issue shares to them and get money to the organization. This is very, very selected people you are going to issue shares. Introduction is where no money created, no share issued, only thing your status becoming unlisted to listed. So these are the four ways of getting listing under equity financing. So continuing on that, we go to the page number 327, cost of share issue on stock market. When the company go for share market issue, what are costs? You could see there are underwriting cost, what I mentioned earlier. In order to make sure that all the shares are subscribed, you get an independent or an intermediary who basically supports your company by ensuring that your shares are basically subscribed properly. So any shortfall in subscription which is not invested by public, the underwriter will invest on those shares. So there is a cost the underwriter will charge you, that's called underwriting cost. Then the stock market listing fee, generally initial charge and the ongoing fees for the new securities or new shares. Fees of issuing house, actually it's a managers to the issue, we call it managers to issue. Lawyers fees, auditors and public relation consultant, as I mentioned too, there needs to be a kind of communication regularly. You do it to the public. If you are going for IPO a couple of months back or you start the process, so there will be communication regularly on media, papers. When you take Sunday Times or Sunday papers, you will see there is somebody who is talking about your company. So anybody will get to know there is a company which has been in business, which has been successful. So people get that into your mindset. When the company go for listing or when the offer is made, then when they get the prospectus, you say, okay, I have been looking at this company for some time, then I have knowledge. So these are something happening with the public relation consultant. Then the printing, distributing cost for prospectus, advertising in newspapers, management time. All these are cost of share issue on stock market. So definitely there is a percentage. There is a percentage of cost you have to incur from your issue fundraising. So if you are talking about 100 million rupees, maybe say 5%, up to 5%, you would be incurring to raise the money. So if you say amount is very high, 1 billion, then it can be lower than 5%. So it depends on how it works. I am just giving a guideline. There will be a cost involvement. That cost will be overall cost when overall money you are raising from the IPO, when you compare with it, the cost may be negligible because this is not something you are doing every year. You raise the money today, after that it will be there for so long period. So you don't mind incurring that cost in raising the money from share market. So they have talked about what are the things you will look at in share market when you are going to issue the price. What are things you will look at it? So there are factors they have mentioned. Current market condition, price of similar quoted company, desire for immediate premium, future trading prospects. So earlier what I talked about 16 rupees, 18 rupees. Then after you go for public issue and raise the money, then you have got your shareholders. Shareholders also have shares in the company. Then we call another issue called right issue. So what is right issue? This is actually you issuing shares to existing shareholders. You issue shares to existing shareholders proportionate to the existing shareholding. Right, you are issuing shares to the existing shareholders proportionate to the existing shareholding at a price below the market price. So you may be a company already listed, you have issued shares to public, so there are shareholders in your company. After say 5 years down the road, you want further funding. So what are you going to do? You basically inform the shareholders, the existing shareholders, look at it, I am going to issue shares to you at a price below the market price, proportionate to your holding, proportionate to holding. For example, if you have 4 shares, I give you 1 share. If you have 4 shares, I give you 1 share. And if the trading price today is 20 rupees, I give you the share at 18 rupees. So the shareholder will say, okay, I am getting a privilege. I am getting a privilege of buying shares of my own existing ownership company at a price below the market price. So that is the privilege I am getting. Right issue is you are giving a privilege to your existing shareholder to participate in the company's growth or expansion by contributing the money at a lower value, lower price. You don't have to pay the same market price, you get a lower price so that you have advantage of your difference between your market price and your right issue price. This is called right issue, right issue. So when you look at the right issue, there are pluses, there are minuses. So what are the pluses? So if you look at the study pack, I just go through. One is right issues are cheaper than offer for sale to the general public. So if you are a shareholder already, for you the shares are issued at a lower than the market price, definitely that's advantage to you. Then right issues are more beneficial to existing shareholders because you are getting attracted of the discount that you are getting, right? Then the other thing, your voting rights are not affected. You will still continue to own the same percentage unless your existing some other shareholder don't subscribe. If every shareholder is going to subscribe to your shares, then the share ownership will not change. For example, you say there are A, B, C, 3 shareholders. Say, right, you are talking about 120,000. 120,000, right? This is 360,000 existing number of shares, present shares. Assume that you are going to issue right issue. What is the arrangement? You are going to give 1 share for 3 shares, 1 share for 3 shares held. So if existing shareholder have 3 shares, the right issue terms is if you have 3 shares, you get 1 share. You get 1 share for 3 shares held. On that basis, 120,000, the shareholder A will get how many? For each share or each 3 shares, you get 1 share. That means you get 40,000 shares. Same way here also 40,000 shares. 40,000 shares. So total number of shares 120,000, that is 1/3 of this. After right issue, you will see the total number is 480,000, 160,000. So this is if the, please understand this, if all the existing shareholders, all 3 shareholders, they subscribe to the right issue. This is what they are entitled to. If all the existing shareholders buy the right issue shares, they subscribe for the right issue shares, then the ownership of ABC will not get diluted. In this case, you know that 1/3, 1/3, 1/3 or 33, 1/3, 33, 1/3, 33, 1/3 is the percentage of ownership of ABC. This will not change even after right issue. Same percentage of ownership. 33, 1/3, 33, 1/3, 33, 1/3. So you get the same ownership, provided all 3 shareholders subscribe to the shares fully. They subscribe to the shares fully. In case one of the shareholders don't subscribe, and that existing shareholder right issue is subscribed by other 2 shareholders, then what happens? Your shareholders' existing ownership get diluted. Existing shareholders' ownership get diluted only when if all 3 shareholders or if all the shareholders don't subscribe fully. If they subscribe fully, you don't have to worry about it. Existing shareholder ownership don't get diluted. Okay. So this is something you need to be knowledgeable, because the examiner on and off test on this area, the right issue transaction, whether the ownership get diluted or not diluted. So Generally the right issue, you are raising money from equity form. So when you say the equity form, you are getting right issue money, your equity capital goes up, So what happens to the gearing? What happens to gearing? You will see that you have equity capital, debt capital. Equity capital and debt capital. So if you say 100% equity, equity is 60%, debt is 40%. So when you say right issue is done, right, you will realize that your equity capital increases, debt capital no change. Then after right issue, what happens? Your 60 may be going up, so 70%, and your debt capital can be 30% out of 100. So please understand that when you are going to raise money from right issue, you are talking about your equity capital going up. Why you are getting equity money, stated capital will go up. When it goes up, your debt capital no change. So percentage wise, capital structure percentage wise, equity capital increases, debt capital reduces. So that is basically gearing. What happens? Reduces. So keep that in mind. When you are going for right issue, your gearing comes down. When the gearing comes down, all of you all may be knowing, your financial risk comes down. When your gearing goes up, your financial risk goes up. When the gearing comes down, your financial risk comes down. Then what are disadvantages? What are the disadvantages of right issue? Minus of disadvantage or minus of right issue. So if you take the study pack, right issue may limit your capacity or the expanding capital because you are issuing shares to existing shareholder. So when you are going for right issue to existing shareholders, especially on unquoted company, their existing shareholders have a capacity. So if the existing shareholder cannot subscribe to your right issue, then you don't get your required capital. So your objective is not achieved. Might as well you go for IPO in the market and raise public money. The right issue means the right issue can be done by a public company or private company or unlisted company. Unlisted company can issue shares to existing shareholder and raise money. That is also called right issue. So the existing shareholder of unquoted company may not be subscribing fully. They don't have enough capital or they don't have enough money. So in that case, it's a disadvantage to the company because you are not getting what you want. So might as well go to the public offer and get the money. Second, the pricing. What is the right price for right issue? That could be an issue you will have in right issue, right? Deciding the right issue price, whether it's a overpriced or underpriced, whether it's attractive to investor. So something you need to be worried about in the right issue. Then if you are talking about an unlisted company, it's actually disadvantages are mainly on unlisted company. Unlisted company, when you are going for the right issue, you are not increasing your shareholders. Your own, say 10 shareholders are there in unlisted company. Right issue, you are giving shares to the existing shareholders. So same 10 shareholders will be there in your company. So there is no change. In your number of shares or the number of shareholders. So you are not increasing or widening your shareholders. Okay, that is also there. Then you can look at the study pack, page the 3.3, pricing of right issue. If you look at that example, pricing, how the pricing works. Now see, ABC company can achieve a profit after tax of 20% on capital employed. ABC company can achieve a profit after tax of 20% on capital employed. At present, capital structure is 200 million, that is share capital or stated capital. Retained earning 100 million, total 300 million. So your equity capital is 300 million today. Directors propose to raise additional 126 million from the right issue. So 300 million equity company going for 126 million right issue. Current market price is 1,800. Question is asking you, calculate the number of shares that must be issued if the right price is, they are given a range of prices. Calculate dilution in earning per share in each case. So there are two parts. One is calculate the number of shares and each price. Second, calculate the dilution in earning per share in each case. So when you look at the answer, firstly they take your present equity capital, which is 300 million. 300 million, your return on capital employed is 20%. So they are talking about 60 million you will generate. You will generate 60 million. So your earnings per share, this is earning per share, 300 per 300, that is actually present, your earning per share is 300. 300 is your present earning per share. Because you have 200,000 shares, 60 million is your earning, so 300 rupees per share is the earning per share. Earnings after right issue. After right issue, you are getting 126 million excess. So 300 million you have equity capital, another 126 million you have raised. So total 426 million you have. 426 million if it's your equity capital, on which you get 20% return, which is 85.2 million. 85.2 million. So when you go to the next page, so you will see that price ranges 1600 to 1200, there are price ranges, that's the right issue price range. So that the next column says number of new shares, that is because 126 million you are going to raise, that's your objective, 126 million. If this is a price, if it is a price 1600, you are talking about how many shares you are issuing, 78,750. Similarly, if you are talking about 126 million you have to raise, pricing is 1200, another 5,000 shares you are issuing. Then the earning per share, they are calculating the new earning per share. 85.2 million is the new earnings from your total capital. That divided by total number of shares, they are given you the earning per share one by one. Then they show the dilution. So you can see, if the share is issued, right issue is at 1600, you will see that your earning per share will go up by 6 rupees. If you are going to issue the share at 1200, your earning per share will drop by 21 rupees. So this is your dilution. And at a break-even price, that is 1500. If you go and issue at 1500, which is actually your present value per share, book value per share, that is 300 million divided by 20 million shares or 200,000 shares, you get 300 rupees is your market or earning per share. So that will not change if you are going for 1500 issue price. So this is basically to show you how the right issue price will dilute your earning per share. Then there is something called theoretical ex-right price. Okay, you have study pack examples also. I might take another example so that it's easy to understand for you. Theoretical ex-right price, for example, say Y company have 1 million shares and the market price is 20 rupees. Company going for right issue, say 1:4. Right, one share will be issued for 4 existing shares older. If anybody has 4 shares, you get 1 share. And the price is 15 rupees. Right issue price is 15 rupees. So please note that your company has 1 million shares. Market price at the moment is 20 rupees, that is before the right issue. Right issue is done at 1:4, that is existing shareholders. 4 shares older will get 1 share at 15 rupees. Now, generally, immediately after the right issue, your share price will come down. Immediately after right issue. The reason being, your shares at the moment trading at 20, but your right issue shares are issued at 15. So actually your share value needs to come down. Why? Your right issue shares are below the 20 rupees. If you are issuing the right issue also at 20 rupees, no change in the market price. But since you are issuing new shares at a lower price, your average price after the right issue comes down. So how do you calculate theoretical ex-right price? Is basically before the right issue, so the person who has 4 shares, he would have had the shares, 4 shares at 20 rupees. That means his portfolio would have been 80 rupees. 4 shares into 20, 80 rupees. Plus, he is getting a 1 share for 4 shares held. So, 1 share he is buying at 15 rupees. 15 rupees. So, he is going to get 4 shares he has earlier before the right issue, 20 rupees. 1 share he is buying at 15. Then total shares after right issue, 5. Total shares he will have after right issue, 5. So, you are talking about 95 divided by 5. 95 divided by 5, which is 19 rupees. 19 rupees. Okay, so your answer would be 19 rupees. So, you will be seeing that your 20 rupee shares has become 19 rupees. 20 rupee shares has become 19 rupees. That's why I said theoretical exercise price comes down. Theoretical exercise price comes down. Your 20 rupee share comes down to 19 rupees. So, you can look at the example in the study pack also. Your theoretical price comes down. Then there is a calculation of value of right, which could be understood. You can understand the example there. So, in the right issue, the shareholder has certain options. What are options? If I am the shareholder who are given the privilege of subscribing for right issue. So, when I know that I have a right to subscribe for my right issue, first thing I have option is to subscribe. I subscribe means I buy the right issue shares. I have to pay and buy. In my example, you have to pay the 15 rupees and buy 1 share. I can do that because I am entitled. So, that is my right. I am subscribing. I am using my right. So, you can see that take up or exercise the rights. That is first thing any shareholder could do. Possibly he has money, he can do that. Second, renounce the rights and sell them on the market. Renounce the rights. I don't want the right issue, and then basically I sell that in the market. So, my rights have a value. I can sell that rights in the market and realize some money. So, that is the second option I have got. Third option, I can take some portion of my rights, because sometimes if I am a larger amount of investor, I may not be able to subscribe to the entire right issue because there will be a lot of money I need. So, what I do is I will subscribe half of the right issue, half of the rights I will sell it in the market. So, because each right has a value, previously you would have looked at the example, there is an example. So, each right has a value. So, I can sell the value of the rights in the market and realize some money. Some rights I will subscribe. So, that I get right issue shares also. Fourth one, I don't do anything. So, that is basically the fourth option I have got. So, you have an example you can go through that is self-explanatory, that will help you to understand what are the action you can do in the right issue. Then we look at share repurchase. Actually, this is something the examiner used to test. It's actually buyback of your shares. Maybe previous Company Act didn't allow the buyback in Sri Lanka, but 2007 Company Act, when it was brought in, it includes a provision for you to buy back your own shares. Now the question is, why the share buyback happens? That means the company is buying its own shares from the shareholders. Company buying its shares from the own shareholders. Already they are the shareholders. I buy the shares of them to the company. There are various reasons the buyback takes place. Various reasons. Generally, if you are a unlisted company, 10 shareholders are there. Unlisted company, 10 shareholders. Say we talk about unlisted company first. Unlisted company. I am one of the shareholders, there are 10 shareholders. And I realize after 10 years of my associating with the company as the owner. Now I want to withdraw my money, or in the sense I want to sell my shares. So I can ask the other shareholders to buy the shares. But other shareholder is an unlisted company. Other shareholders say, no, I don't have money to buy at this moment. So what do? So I want to exit from my investment. Maybe I want to go to another investment opportunity, or I want to retire from business, various reasons. So when I want to do that, I go to the company and say, can you please buy my shares? So the company needs to agree with the other shareholders, fine. If the other shareholders are also willing to do that transaction, company will buy back its shares. I think 2021 March paper, the Bangladesh question, if you look at my last webinar, you will see that it is a buyback transaction by the Bangladesh company from the existing shareholder. So one shareholder wants to get out of the existing investment, and the company decides to buy back its shares. So that is unlisted company. The shareholders agree that we will buy the shares from one shareholder. That is, company is buying its shares back. So that's the unlisted situation. Maybe in a listed company, you would like to do the buyback. Why do you want to do buyback in a listed company? There are various reasons again. One of the reason is that you realize your share price is undervalued in the market. When you realize your share is trading in the market at a lower price or undervalued price, there is always a threat that somebody can take over your company. Since you are a listed company, there is a possibility that somebody could buy your company. So in order to avoid that, what you can do, you want to increase your value, or you want to change your undervaluation situation. So what do? I buy back my shares. In the sense, the company is buying back its shares. When the company buy back its shares, automatically number of shares comes down and the market value per share goes up. So this is where the main reason in a listed company you would buy back its share, where you realize your shares are undervalued. So that is one reason why you want to buy back your own shares. So that is where share is undervalued, you want to buy back. Unlisted company, exit for investor. If the investor wants to exit from the investment, you are allowing him to do that. Unlisted company, you will see that you have excess money. If you realize, your company realize that you have excess money and you don't have much opportunity to invest. You have excess money and you don't have opportunity to invest. So the shareholder would prefer you buying back their shares, so that the shareholder will get their money back and they can invest in other alternative investments. So in order to allow that to happen, you basically will buy back the shares. So there is excess money. When you realize that your company has excess money, I think 2021 March paper talks about it. Then you want to change your equity base. One of the other reasons why you want to do the buyback, changes your ownership structure, right? Then when you do the buyback, you will realize that your company gearing will change. Then we look at the drawback, right? As I mentioned here, undervaluation situation, and you are trying to avoid takeover. These are some of the reasons why you do repurchase or share buyback in a listed company. Unlisted company, it probably will be the existing investor wants to get out. Existing investor would like to get out. And the excess funds. So these are some of the reasons why the share buyback takes place in organization. Then there are drawbacks or the issues. One is the price. What is the right price to do a buyback? So you need to be very careful in calculating number, because the existing shareholder may not like to sell the shares at a wrong price or the unfair price. Similarly, company cannot pay excess price to the existing shareholder, somebody who is going out, so that other shareholder will penalize. So there will be a difficulty in getting the right price. That's one. Then you are giving a communication you are giving a communication when you do buyback to the shareholder that your company does not have enough opportunity to invest. Does not have enough opportunity to invest. So that is something a wrong signal you are trying to tell the shareholder. That means why the shareholder invested in your company? Shareholder invested in the company in order to get good return from your business. So now you are telling the shareholder, sorry, I don't have enough opportunity in my business, please keep your money back. I am returning your money back. So this is something a negative thing. So you need to be understanding there is an impact. Negative side. Third one, when you are going to pay dividends, annual dividends, there will be taxation. On the other hand, when you are going to do the buyback, there will be another way of taxation. So that depends on the scenario and what kind of transaction and what time period, because taxation laws changes regularly. So when the taxation changes, you might be as a shareholder preferring to get dividends rather than capital gain, or the other way also, vice versa. So please note that also can be a disadvantage when you are doing a buyback. Because buyback is a capital distribution. So capital distribution means you are calculating capital gain. So unlisted company, the way of calculating is different. So when you do that buyback, the capital gain may be liable in an unlisted company, then it may be disadvantage for you as an investor than you holding the shares. Then employee share ownership plan, ESOPs, employee share ownership program, right, or plan. So what is this? You give, the company gives the existing employees of your organization the right to buy shares, You basically look at your organization employees and you identify the employees who have worked for so many years. You will have a criteria and say that 5 years you have worked or 10 years you have worked and you have been in this position. Based on the criteria, you will decide X amount of shares to be issued to employees, or you are not issuing the shares to the employee, you are giving the right to the employees to buy the shares. Generally, under the program, the employees basically don't pay any money to buy the shares. They get free of charge. They get the shares free of charge. So when you get your, say, employee share option program, you will see share ownership program, you will get your shares free of charge, but it's based on your number of years of service and your designation in your organization. There will be a criteria. So the advantage of giving this, employees will be motivated. One, why? Employees also become owners of the organization. Not only they are working for the company, they are going to get ownership in the company, so that they will know that in addition to my salary and other perks, I am going to get dividends for my ownership, and I will get capital appreciation also. So therefore, I would like to be part of the company as a owner. So that is one advantage where the employee get motivated. Second, when you say there is a criteria where it restricts that employee needs to be having minimum number of service in the organization, then you are making sure that you are retaining employees in the organization. So that is your one strategy of retaining the employees in the organization. If I say I get 10,000 shares, if I work for 10 years, I would like to work for the company, because I know that a huge benefit I get in addition to my salaries. So when I calculate, I will definitely benefit out of it. It's a good company, I will definitely benefit. So I would like to retain, I would like to be in the company for some time. So that basically motivates employees to stay in the company rather than just leaving every 2-3 years. The negatives of employee ownership program is that it dilutes the earnings to other shareholders. We always remember that when you are issuing shares to somebody other than your existing shareholder, your ownership get diluted. IPO, the ownership get diluted. But right issue, generally no dilution. Unless somebody doesn't subscribe, right issue also dilutes. But IPO dilutes. Why? Your existing shareholder shares are there and you are issuing new shares to public. So when the new shares are bought by public, your existing shareholder ownership get diluted. So the employee shares are also something like that. You are issuing shares to your employees in addition to what your existing shareholders are. So existing shareholders, in addition to employees, when they come, the existing shareholder ownership get diluted. So that's a disadvantage. Second, employees' point of view, they are getting into risk. What is the risk? When the company not perform well, company fail to perform well, not only you lose your income or remuneration or employment, you lose your investment also. Right, your share investment that you had, if the company fails like later part of the years, you will realize that you will lose your employment income or you will lose your employment. On the other hand, you lose your ownership or the investment also. So that's a disadvantage or risk of the scheme. So these are the pluses and minuses. Please be aware that the examiner on and off test in this area, and they basically wanted to know whether you are having a knowledge about this employee share options, share ownership scheme. Actually, this is about employee share ownership, but there are something called employee share options also, right? Slightly different, where there is a share options, you will be given right to buy the shares, at a price. So when you go to buy the shares at a market price, you will see whether it is beneficial or not beneficial. Here, share ownership plan or program where the company allocate amount of shares to the share employees based on their criteria, with basically on your number of years of service and your position in the organization. So a little different employee share option and share ownership plan. So there is a difference. So what we have talked about. Then we move on to we are talking under equity finance. Study pack, one of the other concept is management buyout. What is this? Your management of the company buys shares of the company. When I say shares, actually you are getting, I would say, controlling interest. Your management, assume that you are an organization, your management of your company now sees that there is a potential that management is contributing a lot to earn the business income. So you may realize that it's better that we become the owner of this company. So that small organization, maybe it's very difficult to do at a very larger companies, because larger companies, you know that its value of the company is very high, so management may not have so much of money to buy the larger company. Very rarely it happens. But smaller organization, reasonable size company, the management realizes that they are the main people who contributes and earn. So they decide that they will buy the organization. They will tell the owners, look here, we are willing to buy. Then if the owners are also willing to sell, the transaction takes place. This is called management buyout. So in the management buyout, generally the management may not have full money, total money what is needed. So the management will use a financier. It can be a venture capital company, or it can be a bank, or it can be intermediary. They will get the money and buy the ownership in the company. So you might have seen there are service organization where the key success of the organization is the employees, especially the senior lot or identified employees. So those people can easily buy the organization, or in the sense they will be interested because they understand it's me who contributes. For example, you say a software development company, or advertising company, or even travel company, right? The employees realize that maybe 10 people, we are the people, we are the company, we are the owner actually. So they have that mindset that I become owner of this company, I can contribute a lot. I can develop my organization. So they will buy the organization. Owners also will probably decide at a point in time, there can be reason for the owners to sell also. One is owner will see it's right time for him to get out of some business, because they have been there in business and they have made some money, so they want to get a right price and they will sell it to the existing management, so that they are feeling that the business will continue. One. Sometimes the existing owners realize that this business segment is not generating sufficient return for their point of view. their point of view, the returns are not sufficient. So they want to exit from this business and get into another business. So owners can get out like that. Third, they also, part of the succession planning, they want to push it to the next level through the management buyout. So there are various reasons why the owners want to sell out. The management point of view, they would want to get into business, they want to become owners, they want to contribute and develop the business, various reasons, they will buy the company. Only thing, in terms of funding, if they don't have enough fund on their own, mostly it's not, they will get the bank or intermediary or venture capital company to finance the transaction. So this is about the management buyout. So you could read out, there are differences, they are just slight differences they are talking about in names. So they are talking about role of venture capital company. So always remember that it's a good thing because management also are able to earn money, develop the company. Their future is very bright because they understand that that is something, their contribution has brought this company to this level. So this can go to further higher levels by becoming the owners. So that is the management buyout reasoning. And the venture capital company or any financial organization will support that kind of thing provided the management is what you call creditworthiness and they have a good name in the business. All that will be looked after by the venture capital or anybody and they will fund the organization to do the buyout. Then moving to another terminology called leverage buyout. Leverage buyout. This is where you will see a listed company is acquired by a privately established company. Privately you establish a company, private company to buy a listed company. Listed company. So many management buyouts are leverage buyouts. So what you do, a listed company if you have, you will say that the listed company shares, the private company you establish and you buy the owners shares so that listed company becomes, actually speaking, listed company becomes unlisted. Why? Listed company business is bought over by the private company. So this is called leverage buyout. The reason for the company going for private, right? Public company may decide that we better now get into private level. We don't want to be a listed company. So they will create a private company and the private company will buy the listed company. So they are talking about advantages of leverage buyout, right? One is that you don't want to be listed company, as we told at the beginning. There is a cost of meeting the listing requirement which can be saved if you become private company, and your share price will be volatile if you are a listed company. Unlisted company, you don't have to worry about share price, and you are not going to be taken over by anybody. There is no risk of taking over, right? Concentrating on the long-term needs of the business rather than short-term expectation of shareholders. So these are some of the reasons. Disadvantage of leverage buyout. Main disadvantage of the leverage buyout is it loses the ability to have the shares publicly traded. So there is no share trading. Why? What we said, the leverage buyout is private company buying into the listed company. So private company basically takes over the listed company shares, ownership. So when you do that, the public listed company no more. The private company will be the business. So private company shareholders cannot see their shares being traded because there is no market for their shares. If you are a listed company, you would have seen your shares being listed and trading daily basis, you would have seen that. Now you can't see that. So that's basically the disadvantage of leverage buyout. So your chapter 12, what we discuss mainly onto equity financing. So equity financing, how it takes place, what are the ways the equity financing happens and how the listing process happens, what are listing types we have, and what are the capital market activities, and what are the right issue plus minuses, and how the ownership get diluted, all those aspects we discussed, and the cost involvement in the listing process, and the management buyout what we discussed last. So those are the small concepts we have talked on the equity finance.